Genesis Energy just missed their Q1 earnings estimates by a massive 22 cents, reporting a 6-cent loss per share.
Yeah, on paper, it looks pretty rough.
Right, but their stock barely blinked. And management, they confidently doubled down on their massive full-year growth projection.
Which is wild to see.
It is. So, welcome to the deep dive. Our mission today is to decode the May 7, 2026 earnings report for Genesis Energy, ticker symbol GEL. Because, for you listening, what looks like a broken machine on paper is actually a masterclass in long-term strategy.
Definitely. If you picture an offshore oil rig in the deep waters of the Gulf of Mexico, just slowly transitioning into a fluctuating financial chart, you're basically seeing the exact visual for the tension we're unpacking today.
I like that visual.
Yeah, it's the absolute definition of Wall Street's rigid 90-day stopwatch, clashing against the physical reality of the Earth's 30-year geological clock.
Okay, let's unpack this. Because, if a company misses earnings by 22 cents in a single quarter, how in the world can they confidently maintain their massive growth guidance for the rest of the year?
It seems crazy, right?
Yeah. A miss that big usually signals a structural flaw. Are they just hoping for a miracle in the back half of the year?
No, it's definitely not a miracle. It's really just math, timing, and understanding which metrics actually matter for a midstream infrastructure company.
Right.
So to establish our baseline, we have to look past the earnings per share, or EPS, because EPS includes a lot of non-cash accounting items like depreciation on massive pipelines.
Which they have a lot of.
Exactly. Instead, if you look at the actual cash generation, Genesis's revenue actually grew 12.1% year over year.
Wow, so revenue was actually up.
Yeah, up over 12%. And their adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, came in at $140.9 million for the quarter.
And for you listening, in the infrastructure world, EBITDA is basically your holy grail, because it's a much better proxy for the actual cash the business is throwing off.
Precisely. And that cash generation is exactly why management expects full year 2026 adjusted EBITDA to hit the midpoint of their previous guidance.
So they aren't backing down?
Not at all. They're still projecting a 15 to 20% growth over a baseline of roughly $500 to $510 million from 2025.
But that still leaves the question, of why the first quarter fell short of the immediate estimates. If revenue is up, where did the friction come from?
Well, the Q1 shortfall was actually largely expected.
Really?
Yeah, Genesis warned everyone on their previous year-end call that several of their producer customers had scheduled turnarounds.
Okay, and a turnaround is basically a massive planned maintenance period at those key offshore production hubs, right?
Right. The producers literally shut down the platforms to upgrade equipment and perform safety checks. And those specific hubs tie directly into Genesis's pipeline systems.
Got it.
So one of those turnarounds simply ran a little longer than anyone anticipated in the first quarter.
Okay, so the oil literally stopped flowing for a few extra weeks, which means Genesis isn't collecting their toll fee for moving it. But that oil hasn't disappeared. It's still sitting down in the reservoir waiting to be pumped. So, it's deferred revenue, not lost revenue.
That's a great way to put it. Deferred, not lost.
Yeah.
And layered on top of that temporary delay, Genesis is actually seeing structural upside from the broader global macro environment.
Right. And just to pull back the curtain for you here, our goal is to look strictly at the economics today. We aren't here to weigh in on the geopolitics of Middle East trade routes or, take sides in global conflicts.
Of course.
But from a pure infrastructure and supply chain standpoint, these global disruptions are creating some pretty unexpected realities for domestic players.
They absolutely are. Look, when you have severe disruptions in traditional hydrocarbon trade flows in the Middle East, global supply chains have to get rerouted.
Right, which creates massive logistical inefficiencies.
Exactly. And Genesis management noted they're capturing incremental margins specifically because of these dislocations. Yeah, when international routes are unreliable, domestic flow assurance, basically knowing exactly how and where your energy is moving within the Gulf Coast, that becomes incredibly valuable.
And customers are willing to pay a premium for that reliability.
100%.
Well, here's where it gets really interesting. To understand why this quarter's numbers are so deceiving, we have to look beneath the surface.
Literally beneath the ocean floor.
Right, literally. At a deepwater asset called the Shenandoah Floating Production Unit, or FPU, because Shenandoah is basically the culprit for a $12 to $15 million hit to Genesis's 2026 segment margin.
And look, if you're an analyst just staring at a spreadsheet, a $15 million hit looks terrible.
Yeah, it does.
Shenandoah came online last year with shockingly high initial flow rates. I mean, they were producing oil far faster than modeled. But in Q1, the operator of the field intentionally reduced that production rate.
Wait. If Genesis and the producers make money based on the volume of oil flowing, why would they intentionally slow down a gusher? That seems entirely counterintuitive.
What's fascinating here is the physical reason for that reduction. The operator analyzed the first 4 phase I wells at Shenandoah after a few months of production,
Okay.
and they found that the bottom hole pressures were stabilizing.
Let me stop you there. What exactly is bottom hole pressure, and why is it stabilizing a good thing?
So think of bottom hole pressure as the natural internal energy of the reservoir.
Okay.
It's the raw pressure down in the rock that forces the oil up the wellbore to the surface. Usually as you extract oil, that pressure drops quickly.
Makes sense, like letting air out of a balloon.
Exactly.
Hmm.
But at Shenandoah, it's stabilized because the operators realized the field is connected to a massive associated aquifer.
Wait, really?
Yeah, there's an enormous underground water source pressing against the oil reservoir.
Okay, I'm trying to visualize this. It's like an underground lake pushing against an underground lake of oil.
In petroleum geology, this is known as a natural water flood. As the oil is removed, the water naturally rushes in to take its place, maintaining that bottom hole pressure and constantly pushing the remaining oil toward the well.
Wow, so nature is basically doing the pumping for them.
It's a fantastic mechanism because it significantly improves the cumulative recovery. The total percentage of oil you can extract over the lifetime of the field.
Right.
But it comes with a major catch, governed by the physics of fluid dynamics.
Oh boy. So if the oil is highly viscous, meaning it's thick and heavy and the water is highly fluid,
Right.
it's like drinking a really thick milkshake with a straw. If you pull too hard and too fast, you just suck up the watery milk at the bottom and leave all the good, thick ice cream stuck to the sides of the cup.
That is a perfect analogy.
You end up ruining the milkshake. You have to pace yourself to get everything.
Exactly. And the industry term for ruining the milkshake is water coning.
Water coning.
Yeah. If the producers pump the wells too fast, the thin water will literally cut through and bypass the thicker oil, rushing directly into the wellbore.
Oh, wow.
And suddenly you're spending millions of dollars pumping worthless salt water to the surface instead of oil. And once that water channel forms, a massive amount of that thick oil is bypassed and trapped in the rock forever.
Which brings us back to the earnings miss. By intentionally slowing down the production near term, causing that $15 million hit to Genesis's current year guidance, the operator is preventing water conning.
Exactly.
They're actively increasing the total calculated oil in place and maximizing the cumulative recovery percentage over the field's entire 20 to 30-year lifespan.
They're sacrificing a fraction of their immediate quarterly cash to ensure a massive, decades-long payout.
Wow.
And for a company like Genesis, which gets paid a contracted toll fee for every single barrel that flows through their pipes over the next 3 decades,
Yeah.
a stronger, longer-lasting reservoir is the absolute best news possible.
Because it secures their cash flow well into the 2050s.
Right, even if it slightly dents the 2026 spreadsheet.
That completely changes the framing. Wall Street sees lower volumes today and panics. The geologists see a natural water flood, slow down the pumps, and celebrate.
It's 2 totally different perspectives.
But I have a fundamental question about Genesis's business model here. Wait, so all these massive energy majors, that operators are spending billions of dollars to drill these new deepwater wells, build subsea pumps, and install floating production units.
They are.
How much is Genesis spending to connect to all this new oil at Shenandoah?
If we connect this to the bigger picture, the answer to your question reveals the true, almost untouchable moat of Genesis Energy.
Okay.
The answer is zero. Zero incremental capital expenditures.
Wait, what? Zero capex to connect to a multi-billion-dollar offshore development? How is that even possible?
Because Genesis has already established an unavoidable toll road in the Gulf of Mexico. The infrastructure is already resting on the ocean floor. Every drop of oil from Shenandoah flows exclusively through Genesis's 100% owned SYNC and SECO pipelines, or their 64% owned CHOPS and Poseidon lines.
So they built the highway years ago at massive expense.
Exactly. And now whenever a producer finds a new neighborhood of oil, the producer pays to build the on-ramp, and then they pay Genesis a toll to drive on the highway.
And there are a lot of new neighborhoods being built right now. I mean, looking at the near-term activity, a rig is currently drilling the Monument Field, which is a two-well subsea tieback to Shenandoah.
Right, and the first of those wells is coming online before the end of this year.
Plus, you have the Shenandoah South Field on track for first oil in the first half of 2028. To handle all this incoming volume, the operator of the Shenandoah FPU is expanding its physical capacity to handle 140,000 barrels per day.
And that flurry of activity is not isolated to just Shenandoah.
Right.
Over at the Salamanca FPU, they brought their fourth well online ahead of schedule.
Nice.
Yeah, hitting just over 40,000 barrels per day with a fifth well already on the way.
Plus, there are entirely new discoveries coming down the pike. The Tiberius development, backed by Cosmos Energy and Occidental, is slated to tie back to the Lucius platform in 2028.
Which is another Genesis line.
Yeah. And then there's the Bandit prospect, recently discovered by a joint venture of Occidental, Woodside, and Chevron. And the context around Bandit is wild.
Oh, it really is.
It was discovered on acreage that has been contractually dedicated to Genesis since 2004.
That 2004 detail is staggering when you think about it. It highlights the extreme longevity of these offshore contracts.
For decades.
Yeah. 20 years ago, energy majors signed lifetime dedication agreements because building offshore pipelines is incredibly risky and capital intensive. They want a guaranteed takeaway capacity.
So Genesis took on that initial risk, laid the pipe, and secured the acreage.
Exactly. Now, 2 decades later, a completely new prospect is discovered on that acreage, and Genesis captures a 100% of the transportation economics without spending a single dime of new capital.
So Genesis has built this impenetrable zero capex fortress offshore. But infrastructure isn't just about subsea pipelines, right? It's about the entire supply chain.
Definitely.
And when we look at how that product gets moved and refined onshore, that fortress suddenly looks a lot more vulnerable to some intense headwinds. Because Genesis isn't just offshore pipelines.
Right. They have a marine transportation segment and an onshore sulfur services segment.
And both of those onshore divisions face some incredibly choppy waters this quarter. So let's start with the marine side. Genesis operates a fleet of specialized vessels that transport heavy refined products.
And Q1, their blue water vessel availability dropped by a massive 16%.
A 16% drop in fleet availability sounds terrifying. I mean, are clients just abandoning them and going elsewhere? Is demand drying up?
No, the demand is absolutely there. The drop in availability was purely due to mandatory regulatory maintenance known as dry docking.
Okay, dry docking.
Yeah, 2 of their 4 major blue water vessels were forced into dry dock in Q1 to undergo comprehensive Coast Guard inspections and steel renewals.
Right.
A 3rd vessel entered the yard in March, and the 4th is scheduled for June.
Oh, so this isn't a structural flaw in the business. So what does this all mean? Is taking a ship offline for months just the industrial equivalent of taking your car to the mechanic for a mandatory 100,000-mile service?
Precisely. It is completely routine. It means Q1 and Q2 are going to look artificially weak for the marine segment simply because half the fleet is literally sitting in a repair shop.
Makes sense.
But the underlying fundamentals for the marine business remain incredibly strong, largely insulated by the Jones Act.
Right. The Jones Act requires goods shipped between U.S. ports to be transported on ships that are built, owned, and operated by United States citizens.
Exactly.
But I noticed the earnings report specifically mentioned that recent political waivers to the Jones Act had zero practical effect on Genesis's operating lanes. Why is Genesis immune to those waivers?
Because of the specific type of shipping they do. You see, waivers to the Jones Act are typically granted during emergencies like a hurricane to allow foreign vessels to move standard gasoline or diesel along the coast to alleviate shortages.
Right, the standard stuff.
But Genesis operates on dedicated blue water routes carrying heavy, specialized refinery feedstocks that require heavily modified, heated vessels.
Oh, so foreign vessels can't just swoop in and take that highly specialized work.
Not at all. Plus, nobody in the U.S. is currently building new vessels of this class, so the supply of ships is incredibly tight. Once Genesis's vessels exit dry dock and get back on the water by Q3, they're re-entering a market with maximum utilization and strong pricing power.
Okay, so the marine side's issues are just temporary maintenance. But the sulfur side of the business seems significantly more complicated. Genesis processes sour gas streams to remove sulfur at refining operations.
And in Q1, their largest, lowest-cost host refinery suffered severe operational disruptions, which obviously bottlenecks Genesis's output.
Right. But there is a bigger, much weirder economic issue at play here.
Chinese flake.
Yes, Chinese flake. It refers to dehydrated sodium hydrosulfide originating from industrial operations in China. It's dehydrated, packed into shipping containers, sent across the ocean to South America, rehydrated, and then sold primarily to massive copper mining operations.
Right.
So what does this all mean for Genesis? Why is this so specific thing a threat?
Because it's flooding the South American mining market at prices that completely defy capitalist economics.
Defy economics how?
To understand why, you have to look at the logistics. Dehydrating a chemical, shipping it halfway across the globe, and then rehydrating it, that's a highly energy-intensive, expensive process.
Sure.
Furthermore, global sulfur prices are actually accelerating right now, hitting $650 a ton.
Oh.
Yet this competing Chinese product is being offered to mines at prices that shouldn't even cover the cost of the freight, let alone the raw material.
So it sounds like it's being heavily subsidized to capture global market share, ignoring traditional profit margins entirely, which makes it a genuine geopolitical headwind for Genesis.
It really is.
I mean, they simply cannot compete with artificially depressed, uneconomic prices in South America.
They can't. And rather than engage in a race to the bottom, Genesis is actively pivoting. They're restructuring their logistics to target new market applications and higher-valued industrial markets strictly within North America.
Where that aggressive dumping isn't warping the economics.
Exactly.
It's a highly strategic pivot, but it definitely creates near-term noise and margin compression in their earnings.
Without a doubt.
So, to recap the operational side, we have offshore turnarounds, massive marine dry docking, and Chinese sulfur dumping all hitting at once. To survive these capital-intensive periods, and endure routine maintenance while waiting for those zero capex offshore fields to ramp up a company needs an ironclad balance sheet.
Which is exactly what they've been focusing on.
Yeah, Genesis spent a vast amount of Q1 financially engineering their future.
They were incredibly active on the capital structure. They went to the debt markets and issued $750 million in new senior unsecured notes at a 6.75% coupon rate. They took that fresh cash and immediately used it to fully redeem older notes, about $679 million worth, that were costing them a much higher 7.75% interest rate.
Which is just basic smart refinancing, right?
Yeah.
Swapping high-interest debt for lower-interest debt.
Yes.
They also upsized their revolving credit facility, basically their corporate credit card, to $900 million and extended the maturity out to 2031, giving them a massive runway of breathing room.
And then they went after their Series A corporate preferred securities, opportunistically repurchasing $135 million of them.
Because those preferred securities are a massive drag on the company.
Huge drag. They're incredibly expensive to maintain, carrying a very high dividend burden. By executing these combined actions in Q1, Genesis immediately saves the company $12 million a year in hard financing costs.
Wow, $12 million just right off the bat.
Yep, and management noted they had a clear line of sight to save up to $80 million annually as they continue to systematically right-size and refinance the balance sheet over the next few years.
But I have to push back on the strategy a little bit. If they have the cash and the liquidity from their newly issued notes, and this Series A preferred stock is so brutally expensive, why are they just chipping away at it?
Yeah.
I mean, they bought back $135 million, but there's still roughly $394 million of it outstanding. Why not rip the Band-Aid off, borrow a little more, and retire the whole expensive chunk right now?
This raises an important question about the hidden mechanics of corporate finance, specifically bank covenants. Genesis currently has a bank leverage ratio of 5.38x. Their long-term target is to get that down to 4.0x.
And the leverage ratio being their total debt divided by their EBITDA, their earnings. It's how the banks measure how risky the company is.
Exactly. Now here is the hidden trap. Genesis's senior secured credit facility, which is their master agreement with the banks, treats that expensive preferred stock as 100% equity, not debt.
Oh, wow.
Right, so if Genesis were to issue new debt to retire all $394 million of that preferred stock tomorrow, the numerator of their ratio of their debt would instantly spike while their equity drops.
Oh.
So their headline bank leverage ratio would instantly skyrocket past their current 5.38x.
Which would potentially put them in direct violation of their bank covenants. It could trigger a default scenario even if the underlying business was perfectly healthy.
So it's a very delicate balancing act. They have to methodically grow their EBITDA, the denominator of that ratio.
Yes.
And as the earnings from Shenandoah and Monument grow, the ratio naturally drops. Then They can slowly use free cash flow to pay down the preferred stock without blowing up their leverage ratio.
Exactly. They are systematically dismantling their highest costs while keeping the banks happy.
Wow, it requires extreme patience. They're carefully protecting their covenants while engineering a much leaner, far more flexible capital structure for the 2030s.
That's exactly what they're doing.
So when we step back and look at the totality of this Genesis Energy Q1 report, it isn't really about a 22-cent earnings per share miss. That's just the surface level noise that algos and day traders panic over.
It really is. It's a story of a company prioritizing physical, geological reality over quarterly Wall Street expectations. They're willingly taking a small financial hit today to prevent water coning and maximize a 30-year offshore asset.
They're surviving routine, mandatory shipyard maintenance.
Right.
They're intelligently avoiding a subsidized price war in South America. And they're quietly saving millions in interest through highly methodical balance sheet maneuvering.
If there is one massive takeaway for you listening, it is how to read past a financial headline. When you see production numbers drop or an earnings miss, ask why.
Always ask why. Is the reservoir actually failing, or is the operator smartly pacing a natural water flood? Sometimes a drop in output today is the mathematical requirement to double your total yield over the next 30 years.
It all comes back to that tension we started with. Wall Street measures success on a rigid 90-day stopwatch, demanding relentless quarter-over-quarter growth. But the physical Earth, like a massive deepwater aquifer miles under the Gulf of Mexico, operates on a 30-year clock. It makes you wonder how many other critical infrastructure companies out there are currently being drastically mispriced by the market simply because geology refuses to adhere to an earnings calendar. Something to mull over until our next deep dive.